All right, I'm going to start going over point figure. This is important because you don't know how much potential a move has, and that impacts your trading. So what happens is a lot of times when we trade, we just look for a pattern. You get into the pattern, half the time it works, half the time it doesn't. Well, what if there was a way to figure out by looking at the chart that this thing has potential to move 20 points, 10 points, 10R, 15R? Wouldn't that be a valid criteria to include in your trading plan? Obviously, yes, right? You want to take the moves that have a lot of potential. What happened? All right, so the idea here is I don't know what happened to my ruler. Shoot. Oh. All right, so anyway, the idea here is to be able to identify the potential in the market that you're trading, meaning the target. Is it 10R? Is it 15R? Is it whatever? So how do you do that? In the Wyckoff method, you use a point figure. So that's what I'll start. All right, now here we go. This is a chart. This was a stock. I forgot what it's called, Bethlehem Steel. You can use this on Amazon, Apple, whatever, and get forecasts. So the idea, it has to have forecasting value. That's the whole point. It has to have forecasting value that gives you the risk reward, meaning focusing on the reward, telling you how much you're going to go. It's, without that, what do most people do? They just say, okay, let me target the high, right? Say, okay, I'm going to get in here. Let me just target the high. Maybe it goes, maybe it doesn't, maybe it taps it. But if the potential there is heavy, is a lot, it's going to blast through the high, potentially blast through the high and go to much higher prices. So it's better to hold instead of getting out at 3R when the projection based on point figure is like over 10R. Anyway, so we'll just use this. So starting in the month of November at the $70 level, it falls. It falls to what? Around 59 or 60 from A to B. Why is that important? Because it creates an oversold condition and it creates a range, meaning a base, an indication that the force of the decline has been broken. What is the force of decline? Broken because it already went into oversold and now it's going sideways. All right. Why is it oversold? Why? Because it didn't correct. It went straight down. When markets go straight down without corrections, they have a tendency to do what? Get into oversold conditions and bounce. So imagine that this is a strong rally down or like a momentum rally down, and at the bottom of that down rally, like it's like a down move. There's a base. That's what's going on. There's a small narrow base, and what does it do? It tagged the down rally here. This is a rally down. It starts moving laterally, forming a base, and that base has a number of touches at 60. How many touches? 7. All right. Now you can see that 1, 2, 3, 4, 5, 6, 7 at point C. Okay, at point C, from the left hand to the right hand, point C has 7 touches. It begins. What the fuck did I just do? So then, yeah. And then basically what is the line? You just count it, all right? How many times did it go? 1, 2, 3, 4, 5, 6, 7, 8. All right, so the base is 8. So what does that mean? It means that the pullback after this rally down can go up potentially 8 points from C to about D. So if you count that, it's from 60 to around 68. Or if you take the low, which is 59, it would be around 67, right? Where does it go? It goes to 66. So after completing a normal correction of the decline, that is a rally halfway back, 50% retracement to 71. Yeah, halfway of 71. The price falls back quickly to 61 and recovers to 66. All right, so all he's talking about so far is the move goes down from A to B. There's some accumulation of the down rally, right? The rally down, they bought it up to do a halfway back move that goes to 66. After that, it falls back and it comes right comes right back up, meaning goes down and comes right back up. All right. Here it goes into a narrow range that tells us that the rally is meeting supply. The narrow range tells us the rally is meeting supply, and the stock is probably being held within the range while distribution is completed. So what is the indication here? Narrow range. Where else was the narrow range? At the bottom of that rally. Where else is the narrow range? At the halfway back point. Why is it a narrow range? Because they're holding it. Why are they holding it? Distribution. Just like it was accumulation that initiated the halfway back rally, at the halfway point, there's distribution to do what? Continue the markdown. All right? So a line of 8 entries forms across 66 and stretches out to 11 on the wider 65 line. All right, what are you doing at 66? It's 1, 2, 3, 4, 5, 6, 7, 8. Right? So how many boxes do you have? You have 8 boxes, including the spaces. All right? So from the high here, from D onwards, you have 1, 2, 3, 4, 5, 6, 7, 8. That is from 66. You have at price level 66, the halfway back point, you have 1, 2, 3, 4, 5, 6, 7, 8, a count of 8. What about the 65 line? You have a count of 11. Okay, so you have 2 counts, one of 6 and the other of 11. All right. So you get a range, you get your approximation of how much the move is going to go. If you take it from the top at 66, where you have a count of 8, then 66 minus 8 is 58. So that is your projection. 58, because 66 is your level. It has a count of 8. So subtract 8 from 66 and the projection will be 58. If you take the count from the line at from the distribution at the 65 level, you have a count of 11. That 11 will project to 55. Why? Because 65 minus 11 is 55. So just counting and subtracting. It's really not that complicated, right? So all he's doing is he goes down here, does the count from the down rally to the halfway back point, and then from the halfway back point, projects how much the next rally down should go. All right. And that is if the prior support at 64 breaks. I think that, yeah. So underneath the 65. At the last 65, it is on the hinge, meaning what? Dead center, narrow range, ready to puke. I'm going to stop right here so I don't make this video too long. What I want to just highlight is, again, there was a rally from point A to point B. It was a down rally. So what happens after a rally? You have a pullback. Is there a way to measure the pullback? What Wyckoff is doing here is measuring the pullback. He's saying the pullback can go around 50% back, and it is supported by some accumulation. What is that accumulation? It is right here, and it is indicated in this line from 60 and 59. Why? Because you just count the number of touches. At 60, it's 1, 2, 3, 4, 5, 6, 7, 8. At 59, it's 1, 2, 3, 4. But you have to include the spaces. So if you include the spaces, you have 4, 5, 6, 7, about 7. All right, now what he's doing is he's just taking these counts across these lines of accumulation and projecting. So he has two projections, one from the low at 59 and the other from the high at 60. So then what happens? It eventually goes to about 66, which is about halfway back, dips, comes right back up. From this, you can do a count. What is the count? You count the x's and the spaces between. 1, 2, 3, 4, 5, 6, 7, 8. The count here is 8. The count underneath that is 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. So you have two counts, 8 on the pullback high, which is at the 66 level, and then 11 at the line just underneath it, which is whatever, 65. And you just subtract those amounts and you'll get the next projection. All right, that's all. So let's stop right here. The idea is know how to do a count. Second thing to mention, you got to count the white spaces. All right, don't just look at the x's here and say, oh, 1, 2, 3, 4, 5. It's 5. No, you got to count the white spaces. The white spaces are valid for the count. All right, the other thing is, final thing is that even if you have X's and O's, you can count them. I know modern point figure charts don't use numbers, right? Over here, what Wyckoff is doing is he's using numbers, and he's using just X's. The numbers he's using to illustrate the levels so we can follow along in his reading. The X's is before X's and O's, they use just X's. There's no need to put O's. And so this is just like, I guess you could just call it, this is like the figure chart, 1 point figure chart. Not point and figure chart, but the 1 point figure chart. It's a figure chart. All right? That has a 1 point reversal. All right, so that's all I'm going to go over now. And really the point of this is not just to go over some study, but the point of this is to be able to project where is gold going to go? Where is oil going to go? Let's take a look. Is there accumulation? Is there distribution? There it is. How much is it going to go from here? How much can oil fly? Now, is it worthwhile for me to get in? Well, if there's a nice accumulation line, yes, it is. If there's a nice distribution line in, say, the Russell, which right now there is, very important to look at, by the way, then yes, I would consider it, just because the reward is so much on this. It's not like a 3-hour move we're talking about. It's 10-hour, 11-hour, 15-hour, more than that. So this makes very healthy trading, because if without this, what are you going to be targeting? What most people do is they get in and they target the high. They say, all right, we'll make a higher high, let me get out. wouldn't it doesn't it make sense that if you have a big base, not to just get out at the higher high, but to hold it for a substantial move up when it's projecting, you know, 15R, 10 to 15R, why get out at 3R? So there has to be a way to forecast the 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 move, and that's why point figure and these forecasting techniques are important. And I'll give you an example. Like when Jesse Livermore and Wyckoff corresponded, and I have it, it's in here in the course actually. Livermore told Wyckoff that he would never get into a move unless it had at least 10 points in it. At least 10 points in it. So, similarly, like as part of the trading plan, we want to be able to say that this move here has at least 6R, at least 7R, at least 8R, at least 10R, or something, not 10R, but at least you know 5, 6, 7R, or something like that, or at least in that vicinity, right? Before considering it, because you're not only thinking from the risk perspective, but you're thinking from the reward perspective. Instead of just targeting the resistance, you're thinking about how much markup does this accumulation project? How much markdown does this distribution project? Yes, it's worth it for me because my risk is so much smaller than the reward. All right, that's all, folks. Thanks. Bye.